Hi there. So, a new episode with me, which is Hedging with Jorge. And now it's time to develop another exercise, which in this case, I'm bringing a trading company who buys 5,000 tons of aluminum at a fixed price of 2,500 plus a premium of $450. In total, 2,950. That's the cost. Purchased today. Okay? First step. Are you with me? Simple. Bought 5,000 tons of aluminum, price 2,500 with a premium of $450. Good. Here's the point. The company is looking for a buyer. Okay? And the only buyer the company can find is a buyer who accepts these 5,000 tons, is ready to pay $490. $490. Okay? And we see that if we paid 450 and the buyer is ready to pay 490, that we are making $40. But the point is that the buyer is ready to fix the price only at the cash settlement price, not of today, but as of the 20th of August. Yeah? Correct? So let's see how it is in numbers. Watch. There you see the purchase, there you see the sale, and you just see that we have a premium differential with no idea of where the price would be on August the 20th. So we decided to place a hedge. How do we hedge? Selling 200 lots. Remember, 200 lots times 25 makes 5,000. Where? With a broker in the futures market. For when? It should be for August, of course, but not for August the 20th. It's for August the 22nd, because we need to close it 2 days earlier in order to match the date of the fixing of the sale in the physical market. So, for a moment, it looks that we are selling twice. Watch. Okay, when you watch there, you see one sale of the physical and one sale in the futures market. It's like two sales. But here's the point that, as you know, that you can reverse the sale done in the futures market. So let's wait now until when? Correct, until August the 20th. Let's see what happens on August the 20th. On August the 20th, the price goes down to a level of 2,400. Prices go down. So what happens on August the 20th when the prices go down? Watch. As you see here, on August the 20th, the official cash price was discovered, revealed, published in 2,400. That means that the prices went down. And remember, we had established the hedge, and I forgot to mention that, but you can clearly see that at a little higher price, instead of being 2,500, it was at 2,509 because of the contango. Okay? But now time passes by, we get to August the 20th, we instruct the broker to close the future, and since we sold at 2,509 and bought at 2,400, we made at the LME $109, which is a partial profit. Why? If we go to the left side to the physical, you will see our invoice goes out for 2,400, which is the lower price, correct? So we have lost there $100 because we bought at 2,500 in the physical, sold at 2,400, lost $100, made $40 on the premium differential, okay, which brings to a net loss of $60. But if we add the profit made at the LME, the final profit will be $49, because remember, we are adding $109 made at the LME, correct? So when we add up $109 to the amount lost with the invoices in the physical, we end having a final profit of $49. I know it's complicated. It's the very first complication you're going to face. The only solution is to go over and over throughout this video until you understand that. And if you don't understand that, you can always count on us, write to us. I'll be really very glad to help you. Have a good day. Please don't be disappointed. You have to watch it again and again. See you next time in Hedging with me.